Welcome to Catalyst. I'm Madison Mills. 30 minutes into the U.S. trading day. Let's get to the three catalysts we're watching this hour. First up, we bring you the equity market outlook for the second half of the year as traders welcome risk into their portfolios. Plus, we're going to bring you the latest read on the economy with ISM Services data crossing the wire. And we look at the state of the consumer and discretionary spend with the CEO of Topgolf later this hour. What do they see for the back nine? We'll discuss that and much more ahead on Catalysts. Half hour in the start of U.S. trading, let's get you a check on the markets. Taking a look at the major averages here, really interesting to see where the stock market is this morning if we're able to pull that up. Moving to the upside despite the private payrolls data that we indicated through that ADP number coming in extremely soft, indicating hiring hesitancy. We got 37,000. The estimate was 114,000 jobs, a huge miss, and yet stocks continue to rally. We're seeing a little bit more of a reaction if we can flip the board over to the bond market, taking a look at yields, treasuries catching just a bit of a bid here with yields coming in. You've got your 10-year and your 30-year off about 5 basis points here. Perhaps the bond market having an indication that the Federal Reserve may start to react in kind to some of the softening in the economic data that was indicated by that ADP print this morning. Finally here, though, let's take a look at Bitcoin moving to the downside. A little bit of risk-off sentiment still taking hold there. It is under that 105,000 level. I want to take a look at ISM Services Index. That is crossing the wire right now, coming in at 49.9. Economists were expecting 52 here. Just taking a look at that data again as it is crossing the wire. The ISM Services prices paid coming in here at 68.7. That is also a beat to the upside of the estimate, which was 65.1. New orders, a little bit of a miss, perhaps some fall off after a pull forward due to trade policy. That came in at 46.4. The estimate was for 51.6. Services employment, this is interesting off the back of ADP, showing a little bit more strength. The survey data indicating 49, the actual number coming in at 50.7. But again, that ISM Services Index headline number coming in here at 49.9, the estimate being 52, so seeing just a bit of weakness there, falling again below the prior month as well and below the survey data indicated by the economists that were surveyed for the print as well. Joining me now on this, we've got Jose Torres. He is Interactive Brokers senior economist. Jose, great to speak with you this morning. Talk to me about your takeaway from those numbers.
Great to see you, Madison. Good morning. Well, this morning we got numbers that weren't that robust, and that's an expectation given that we've had significant uncertainty on the horizon in the past few weeks with Liberation Day, with on and off tariffs, with progress with certain trade partners, etc. So there is an expectation of hesitancy as we turn the page and look forward to more economic reacceleration themes like lighter taxation, more capital expenditures, milder regulations, low energy costs, etc. I think equity traders are bullish here. They see corporate earnings growing, strengthening into year end. As far as treasuries, I think that yields are too high. I think that inflation is at 2.1%. A lot of what we hear about price pressures is fears, not actual manifestation. And with the 10-year here at roughly in the 440s and the 30-year backing off of 5%, Madison, we've seen a lot of defense at those pivotal critical levels and also 4% on the 2-year. So, overall, soft day for economic data, but yesterday we got a really strong JOLTS number, so it's been mixed overall.
So where does that net out for the Federal Reserve then?
I think Madison absolutely nets out. They should start reducing rates this month. Will they? Our prediction market here at Interactive Brokers is a little shaky on whether they're going to reduce rates as soon as June or July. Are expecting 2 to 3 cuts by year end. Fed funds in the 4s with inflation at 2.1, that's really restrictive in my view, and I think they got to bring rates down.
Well, it's interesting you say that, though, because, and this is obviously just one data point, but when I'm taking a look at the ISM data here, prices paid rose to 68.7 versus 65.1. What do you make of the challenge that the Fed is experiencing right now with the dual mandate? The fact that inflation stays sticky. We haven't even seen the full effect of inflation due to tariff policy, and we're starting to see a softness in unemployment. Where do they choose to focus given that inflationary pressure?
Well, absolutely, Madison. They're going to be focusing on the labor market because the prices paid elements of both the ISM manufacturing and ISM services, that survey respondents answering, verbally. That's not actually physical statistics showing inflation. The actual consumer price indices, producer price, as well as the PCE, it shows that we have seen goods prices start to increase, but the disinflation from services as well as energy and food has served to counter all that goods price pressure. Finally, Madison, goods as a percentage of our economy continues to decline year after year. So we can afford a little bit of an uptick in goods price pressures as long as we have services, energy, and food cooperating. As far as the trade conflicts on cross-border commerce, I think most of the levies are going to be around 10 to 15%, with the exception of China. That's going to stay more elevated, probably around 30 or 40%. But we saw during Trump 1.0, even though we maintained an adversarial posture against Beijing, we still had quarters in excess of 4%. Atlanta GDP now for this quarter, second quarter, showing roughly 4.6%. And finally, data from our prediction market, we see a lot of bullish yes answers being bought on GDP, retail sales, and no answers on recession risk.
Yeah, and just to pull up a quote here from ISM as well, talking about how services PMI being above 48.6 indicates an expansion and indicates in this particular case expansion for the 60th straight month, to your exact point, Jose. But I am curious how long this can last given the slowing in hiring that we have seen throughout several of the labor market data prints, both soft and hard in particular. Is that sort of the start of a slow-moving domino effect that could lead to a slowdown in the economy in the second half of the year that is more severe than this market is currently pricing in?
Well, Madison, I think could is the right word, but what is the probability? I think the probability is pretty low. We saw payrolls slow significantly last summer, June, July, August months, and that's what motivated the Federal Reserve to reduce rates by that out of consensus 50 basis point reduction. That was a jumbo rate cut. And I think we're going to have a similar dynamic now. We're going at the same time that the Fed is going to restart its easing cycle and step down by 25 basis points. I think that's going to coincide with the time when maybe we get a trade deal in India and the EU. And that essentially means that we have trade deal done with almost 50% of the global economy, including the US. So a rate cut, progress on trade, and that really clears the skies ahead for equity investors and for economic growth alike.
I'm glad you bring that up too, because last year we saw a similar dynamic where we were worried about inflation in the first half of the year, then the labor market in the summer, and it seems maybe we're listening to the same record. Jose, thank you so much. Appreciate it.
Thanks for having me, Madison. Appreciate it.
Taking a look at stocks mixed after the big miss in private payrolls and higher steel and aluminum tariffs, with Nvidia's $1 trillion market cap jump spurring traders to dive back into large cap tech names. So how long can the risk-on rally last? Joining me now, we got Noel Dixon. He's the senior macro strategist at State Street. Really appreciate you making the time for us, Noel. Talk to me about how you are viewing the big tech names in this environment. We're continuing to see big tech as the primary leader of market gains so far. How long can that last?
Well, thanks for having me. Well, I think it can last for a while. I think techs, they have double-digit earnings growth. I think, there was a lot of concern about some of the larger names pulling back on their AI spend, but we see that has not come to fruition. They're still, spending on things like data centers. They're going to obviously need to expand from an energy perspective. So I think the tech trade is alive and well.
Talk to me then about how you're thinking about earnings growth going forward, which we have seen coming in just a bit here. And when we look at the index more broadly, we're seeing that earnings guidance is the worst in 15 years over the course of this earnings cycle. Does that apply to those big tech names, or can they buck that trend?
I think they can buck that trend. I think, 12 months forward earnings expectations, I think, is about 12%. I think it'll be double digits the following year. So I think they're impervious to higher rates, tariffs, what's going on geopolitically. And I think if we do get the Fed to cut rates, I think that even helps the valuation story even further. So at this state, I think U.S. tech is still the place to be.
And do you think that we will still potentially get those 2 cuts this year? I know that's what you were anticipating before we even got the soft employment data from this morning.
Yeah, I think we do get the two cuts. I think inflation has been, I think, tamer than most people were thinking, and I think a lot of that has to do with the drop in energy prices. I think that has ancillary benefits as it relates to the cost of goods. Keep in mind that PPI is 71% correlated with the price of gas, 24% correlated with CPI, gas and CPI. So I think inflation will be tame enough for the Fed to cut twice this year.
And how does that inform how you're thinking about flows into the U.S. as we've seen this kind of slowdown in the American exceptionalism narrative, which is interesting given the fact that big tech has really furthered that narrative over the past couple of decades, but instead we've seen this flow to fiscal stimulus and countries offering that stimulus abroad. Where do you see that narrative going in the second half of this year?
Yeah, so I think, to start the year, there was a lot of deleveraging, depositioning, I think, in U.S. tech. So we got to about the neutral territory, I think, as it relates to positioning in tech in the U.S. Now, those flows went largely to Europe, some to China, and investors didn't hedge that exposure. So I think at this stage, I think the best news is priced in to the European market. I think the 500 billion of infrastructure spending, that's only about 1% of GDP in Germany, but they still have low productivity. I think they still have, restrictions as it relates to regulation. So I think it's all of those flows as we get into the latter half of this year are going to repatriate themselves back into the U.S. and they're going to find themselves into tech.
What is required to happen to make that happen for those flows to come back stateside?
Yeah, I think once we get the one big beautiful bill passed, as the Trump administration highlights, that's going to have some things in it that I think will give businesses confidence and investors some confidence. So the 100% depreciation bonus, right now that's dropped to 60%. That's going to go back to 100%. That's going to help with things like CapEx. I think some of the ancillary tax cuts for consumers, no taxes on tips, no taxes on Social Security, so on and so forth. I think that's going to be, driving more confidence with the consumer. And what'll grow clear is that we have this pickup in fiscal impulse. And I think we'll be able to grow at least at trend or above, which will exceed the CBO's 1.8% projection over the next decade. And then it'll become a question of who's the cleanest dirty shirt. And I think the U.S. will be able to stand out in that regard.
And Noel, quickly here, just curious what your kind of differentiating factor is as you look at the markets as a senior macro strategist here. Like, what is your thing, the thing that you use to determine whether or not, you should be doubling down in U.S. tech versus going more international? What is that competitive advantage that you use as sort of an investor playbook?
Yeah, sure. So the two things I like to look at is sentiment, and I like to look at positioning. I think sentiment as it relates to the U.S., despite the recovery rally we've had, has been really negative.
Yeah.
And it's still negative, and it's more constructive for outside of the U.S. And I think what's also interesting is that, foreign investors are more negative on the U.S. than domestic investors. So I think, as we get into the second half, I think that's probably going to flip, and that should be constructive for U.S. assets. I also think, like I said, positioning in the U.S. is still underweight, and it's gotten extreme for countries outside of the U.S. So again, I think that's an opportunity once the narrative shifts for that capital to repatriate back to the U.S.
An awesome overview, Noel. Thank you so much for joining me. Appreciate it.
My pleasure.
Coming up here, the historical connection between the dollar and commodities. Stick around for that next.
King dollar is stuck near three-year lows. Commodities are on the move, but something's fishy in the bond market. I'm Jared Blickery, host of Stocks in Translation. First, if we're going to talk about the dollar, we have to talk about real yields too. Quick refresher, the real yield is a basic treasury yield minus expected inflation, and it's a simple way to gauge growth expectations and Fed policy. Now, Check out this chart. The dollar is in white and the U.S. 10-year real yield is in green. Historically, higher real yields meant a stronger dollar. They'd go hand in hand. And that's mostly held true over the last 5 years, except these 4 boxed areas in red. In June of 2021, January 22, and summer of 23, we saw brief splits where the dollar and real rates, they diverge. But notice the most recent break in April of this year. It is the longest and the most extreme. The tariff tantrum sent the dollar down sharply, even as real yields rose above 2%. So the big question, will the dollar and yields keep reconnected, or is this the new norm? This matters because every major commodity is priced in dollars, and they're also responding to this twist in new ways. First up is gold, which is holding firmly above $3,300 per ounce and getting closer to its record $3,500 high. It is supported by hedge fund inflows, $75 billion annualized and also into ETFs, and also central banks, which bought over 1,000 tons of the yellow metal in the last year alone. Keep in mind, even if the dollar rallies, gold has strong flow support and could easily rise or at least maintain its gains regardless. Now let's talk about Dr. Copper, a global economic bellwether. It surged to a record high of about $5.25 per pound in late March. Then it quickly fell 20% into a bear market on tariff news. Policy headlines are driving copper prices more than the dollar these days. So price action in the greenback alone is less important than macro these days. Pay careful attention to the dollar rates nuance here. Then we have crude oil. It is another one to watch closely because it is a key barometer of global industrial demand. OPEC Plus, it controls about 40% of global supply, and it is just starting now to unwind its cuts, meaning more supply on deck. Watch the $65 level because above that, oil could quickly rise towards $75 or even $80. But to move below the recent $55 lows opens up a potential drop to $40 per barrel, which would not say great things about the global economy. So here's the bottom line. Keep your eyes on 2 variables, the dollar and real yields, as a macro signal. If the dollar drops and real yields also move lower in tandem, expect a broad commodity rally, a classic reflation. If the dollar stays weak but real yields remain high, like right now, gold shines but oil might hold up, and copper, well, that could be choppy to down. And if the dollar bounces and yields stay high, gold is probably the least prone of the 3 commodities to a sell-off. Call it a safe haven, while oil and copper could face pressure. Now, we don't know yet which path the market is going to choose, but this is a roadmap to keep you oriented. And tune into Stocks in Translation for more jargon-busting deep dives, new episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts.
Jared, thanks so much. It's now time for some of today's trending tickers. We are watching Toyota, Apple, and AI. First up, shares of Toyota Industries falling after a bid from Toyota Motor to take the subsidiary private. Tokyo listed shares of Toyota Industries down double digits on disappointment with the $33 billion offer. That's according to Reuters, the offer including a $26 billion tender offer for shares of Toyota Industries. Next up, Apple downgraded to hold from sell by Needham, with analysts citing multiple concerns, including both slow adoption of AI and its large global footprint, aka a tariff risk. This coming as research firm Counterpoint Research cut its expectations for global smartphone shipments from 4.2% to just 1.9% due to tariff uncertainty. Apple's still the weakest performing member of the Magnificent Seven year to date, with losses of 19%, shares up along with the broader market at the moment. Finally, Wedbush securities analyst Dan Ives' artificial intelligence ETF will begin trading today under the ticker IVES, Ives. The Dan Ives Wedbush AI Revolution ETF is pegged to the firm's AI 30 index, which includes familiar large cap tech names like Nvidia, Microsoft, and Tesla, as well as some smaller names like SoundHound AI and CyberArk Software as well. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. We're going to have all your markets action ahead, so stick around if you're watching Catalysts. Wells Fargo CEO Charles Scharf telling CNBC the firm wants to take market share following the Fed's loosening of a major restriction on the bank that stemmed from a scandal over fake accounts. Here to explain, Yahoo Finance banking reporter David Haller. Great to have you on set, David. So explain that commentary for me, because in your reporting you talk about how the company has signaled previously that to investors don't get too excited about an earnings bump off the back of this asset cap lift, but it sounds like they are excited about taking market share.
Right, exactly. I think to explain the asset cap, this growth restriction, effectively they could not do acquisitions or grow their traditional lending business or get into things like capital markets trading. Yeah. So being able to now do that is huge. But I think that in the past, about a year ago or 2 years ago, actually, the CFO was talking about how it's not a light switch moment for the bank. For traditional lending, as an example, to have an environment where they grow their market share, you also do need to have higher revenue. You need an environment where there is economic growth and people are demanding it. So if the bank can take it, it doesn't necessarily mean that demand will be there as much, but market share obviously is something you can do in any economic environment. Yeah,
well, it's interesting then, how does this current macro picture impact the asset cap lift for Wells Fargo? Is this perhaps not the most opportune time for this to happen to them, or would they have taken it at any time?
Yeah, I mean, they would take it at any time. And it's obviously a huge thing for a signal for the trustworthiness of the bank. But that's kind of the debate that analysts are taking right now about whether or not it really will, how quickly Wells Fargo can grow their business. And we're going to hear from Charles Scharf, the CEO, next week. He'll be speaking about this. And one place they can immediately add more revenue is in trading, which takes a lot of capital, which obviously they can grow their assets to do that.
Yeah. Yeah, no, it's a great overview, and it makes me wonder too what their kind of competitive advantage is going to be as the CEO is talking about gaining market share. What is their pitch going to be to take capital from their competitors?
Yeah, I mean, it was a long time ago, but around 2012, that period, Wells Fargo was actually one of the better positioned banks, and that had a lot to do with them getting around a lot of the turmoil that happened during the financial crisis with the other banks. So it'll be interesting to see if they've been able to maintain those relationships, and that's all kind of the story now, because this is sort of a new era for them. So
right, and is any kind of tarnishing of those relationships in their past at this point?
Totally. Yeah.
Great overview, David. Thank you so much. Really appreciate you making the time for us this morning. We're going to stick with this story. The Fed's decision to remove Wells Fargo's $1.95 trillion asset cap is not significant to the bank, according to my next guest. We've got Chris Whalen. He's Whalen Global Advisors Chairman. Chris, great to speak with you this morning. Talk to me about your view on the lifting of this asset cap. You don't see it as a huge lift for Wells Fargo.
Well, I think it's going to be a lift for the bank as it is today. Wells Fargo has exited some very significant businesses over the past 5 years. They have withdrawn from residential third-party lending. In other words, they're not buying loans from other lenders. They're going to simply originate inside their footprint. They have a big branch network. So they're a significant seller. But I would tell you, Jamie Dimon is now the biggest bank servicer. They've taken over from Wells. Wells has also exited commercial real estate to a large degree. They have sold their servicing business to Trimont. So the bank has changed a lot. And yes, they're going to grow. They may see assets grow, but all the banks are going to see assets grow, particularly when the Fed starts buying securities again, because that will make deposits grow. But they're not going to be the same business they were in 2008, for example, when Wells saved the residential mortgage industry. Wells also supported the commercial mortgage industry through that whole decade. So they're not there anymore. And the business they do is going to look more like Bank of America than it does like JP Morgan. So
yeah, I understand what you're saying, that kind of competitive advantage isn't going to look the same. What might it look like? If they called you up for a private chat after this call, what would you tell them that their competitive advantage could look like in this environment?
Well, they got to get their operating efficiency in line. They're still way above JP Morgan and some of the other banks in terms of cost. They're also competing with US Bank now, which bought Union Bank in California, picked up millions of customers. So the competitive landscape has changed. And I think if they're talking about taking share, They're talking about trench warfare with branches and the kind of traditional banking, but it's not going to be the wholesale bank that we saw for the last 15 years. That bank is gone.
If that bank is gone, then it's interesting. I was reading a story in the Journal this morning about how Wells Fargo is well positioned amid this news to take market share from regional banks. Would you agree with that assertion?
Yeah. If you're going to take share, that's who you're going to take it from. You're not going to take share from Jamie Dimon in wholesale lending to mortgage lenders, both commercial and residential. You're going to go after the smaller regionals. You're going to open more branches. You're going to do wealth management, although only domestic. Wells sold their foreign wealth management business, basically wrote it off. So there's been some really significant changes in their strategy, and we'll have to see. They could change again. It may be that they will look at some of these businesses again. But right now, I would say, more shrinkage on the wholesale side and maybe growth on the retail side would be the way I would put it.
How are you thinking about any trading revenue opportunity?
Well, the capital markets business of Wells is a second-tier business. It's not really competitive with the top firms. They had A.G. Edwards out in St. Louis. Again, retail wealth management type of business. Could they acquire some assets and some businesses in that vertical? Yes, they could, but that would be expensive. I think, to me, the real question is not going backwards, but going forward. So yes, we're going to go after share in retail markets. We're going to be a commercial lender to big corporations, but I think that's about it for now until we hear Mr. Sharp talk a little bit more about what his personal strategy is going forward.
Yeah, certainly going to be reporters chasing for that scoop, Chris. I do want to switch gears a little bit. I want to talk to you about Klarna taking on some of the big banks with this offering of a debit card as they kind of try to diversify the business. How are you thinking about these kind of fintech players as potential competitors to big banks, if at all? How would you describe that?
Well, all of the fintechs are catering to a consumer that is not necessarily wedded to a bank in the traditional sense. When we grew up years ago, everybody dealt mostly with banks. They didn't even think about non-banks. Today, non-banks are catering to that consumer in a way that banks have not been able to do so. Look at Zelle. When that first arrived, it took the banks 5 years to figure out how to put Zelle on their websites. So again, Klarna is looking at a customer that may be a little stretched financially, who may need advances on their paycheck, that sort of thing. That's not necessarily a positive example, by the way, for the state of the U.S. economy, but they are meeting a need. And I think that's why you've seen buy now, pay later grow as much as you have. Look, who's the best performing bank in the U.S.? It's SoFi, by far. You know who number 2 is? Bank of New York. So the traditional lenders are kind of way down the list right now. And it's these specialty lenders. SoFi is obviously focused on the same vertical as Klarna, maybe a slightly better customer. But you know what their fastest growing line item is? Credit cards and unsecured, not student loans. So they're hearing what the customers are saying. They're trying to make their offering meet that need. And it's a very interesting commentary on the state of the economy.
Yeah, it really is, but it's more interesting because of the way you laid it out, Chris. So thank you so much for that, and thanks for joining us. Appreciate it.
My pleasure.
Coming up, how investor risk on sentiment is playing out in ETF flows. We'll get you that information next. Since the early April tariff-induced sell-off, investors are piling back into risk-on trades with both Invesco's NASDAQ 100 pegged ETF and iShares Small Caps ETF both back in positive territory. But there are still concerns ahead, especially when it comes to the dollar still being under pressure. For this, I want to bring in Aniket Ulal, CFRA's Research's head of ETF research, for this week's ETF report brought to you by Invesco QQQ. Aniket, great to have you here. Talk to me about what you're seeing in the flows. It seems like investors are buying a little bit of risk in everything.
Well, we try to look at both performance and flows in tandem because sometimes flows can lag performance. From a performance perspective, what you said earlier is absolutely right. We saw a bottom on April 8th, which was, of course, the date when President Trump paused reciprocal tariffs. Since before that date in the year, SPY was down 18%. IBIT, the Bitcoin ETF, was down significantly, as was QQQ, which is really the best proxy from an ETF perspective for the AI trade. all of those ETFs have bounced back significantly since then, most of them 20+%. In the case of IBIT, more than 30%. So from a performance perspective, we have seen investors really go back and kind of take on more risk. To your point about the flows, there are certain categories where we've seen significant inflows. Defense ETFs is one of them, cryptos another. So, both from a flows and performance perspective, it's a much healthier environment now for ETF investors than, of course, early April.
Yeah, and talk to me about those flows into defense ETFs. What is that signaling to you about sentiment?
That I think is really driven by what's happening in the budget reconciliation process. If you look at the budget, there's another $150 billion allocated to defense. This is on top of the $850 billion, of course, in annual spending that's funded through a continuing resolution. So, this includes $27 billion for the Golden Dome project, which President Trump has kind of talked about quite a bit. So this really benefits, of course, the large defense contractors. You've got ETFs like ITA, which provide exposure to the big defense contractors. But there's also another huge component here, which is software automation, process automation, benefits firms like Palantir, C3.ai, and ETFs like PPA, which are kind of broader in terms of their defense exposure and hold some of the software and kind of process automation companies actually benefit a lot from the defense trade. So we actually think PPA is a good proxy, which is in Invesco defense ETF, for the kind of broader defense play when it comes to benefiting from the budget reconciliation process.
That's a really great overview. I want to have you do the exact same thing, but for international ETF flows. What are you seeing there, and what is it indicating to you about where, or I guess how convicted investors are in the narrative that international is going to continue to outperform U.S.?
It's going to be interesting to see how patient investors are with international. In the past, we have seen investors sometimes go to international when we've seen some weakness in the US and then pull back. So far this year, flows have been very strong, particularly within Europe. And we're starting to see in emerging markets ex-China be kind of an interesting trade. Within Europe, of course, Germany is one of the engines of Europe. We've seen stimulus in Germany in terms of 500 billion euro infrastructure bill, spending allocation. We've seen defense stocks really lead that. And the way we think about European allocation is it's really a complement to US allocation, because US ETFs are very, very tech dominated, very dominated by the AI trade. If you look at European ETFs, in general, they tend to have less than 5 to 10% of their exposure to IT. It's a lot more financials, it's a lot more industrials. And industrials really benefit from some of the stimulus we talked about. So we think European trading is here to stay, but it's really non-tech driven. It's much more in industrials and financials play.
Yeah, so given that, because the U.S. continues to win when it comes to large cap tech, how much is the U.S. equity market sort of relying on a dollar snapback in order to have some sort of catalyst to newer all-time highs?
I think your intro, you said it well, which is that, is this 2024? Probably not, because, there are factors that are different now than we saw last year, right? Which was a very AI-driven trade. Now we've got dollar weakness. We've got much more, of course, driven by tariff uncertainty. So this year, we've seen the dollar, if you look at a trade-weighted basket index of the dollar against trade-weighted basket of currencies, it's down about 5 to 6% this year. That's actually improvement from a couple of weeks ago. And because of that, we've seen money go into currency ETFs. You look at ETFs like FXY, which is kind of a yen USD trade. That's taken in over 400 billion. FXC, which is the euro USD pair, is taken in 300 million. So we have seen investors kind of go into currency ETFs as a way to capture some of this dollar depreciation. We have seen dollar depreciation moderate a little bit. But I think there's a lot we need to watch in the next couple of weeks, particularly with what happens with the pause on tariffs on July 9th and how that plays out.
Aniket, really appreciate you joining us. Thank you so much.
Thank you.
Coming up, how economic uncertainty is affecting discretionary spending and what it means for the experiences sector. The CEO of Topgolf weighing in on Catalyst next. Topgolf looking to attract value-conscious consumers this summer with deals as Americans pull back on spending due to economic uncertainty. This comes as Topgolf Callaway brands remains on track to separate into two separate companies this year. Joining us now, we got Artie Starrs, Topgolf CEO, and my morning brief co-host, Brad Smith. Artie, great to speak with you. Thanks for making the time. I want to get your take on the state of the consumer, of course, but first, walk us through what Topgolf's business is going to look like after this split. What are you anticipating?
Well, first of all, Brad, Madison, thank you so much for having me. After the split, we believe we're going to be an extremely strong company, just like we were before. Both businesses were strong, independent businesses before. We're excited about the focus that each business will be able to have on the specific things that we do. In the case of golf equipment and apparel, golf clubs and fantastic shirts and things. And in the case of Topgolf, the amazing experiences that we bring to life in our venues every day that our playmakers bring to life. So we're extremely enthusiastic about the separation and look forward to updating your audience on it as the rest of the year evolves.
Artie, within that, I wonder what the forecast for growth looks like from here. I've been to a Topgolf experience across 6 different states, multiple types of, different premises that they're on, and never send a video to our team because obviously they will figure out a way to make sure that it lights up the screen. But, at the end of the day, these are highly replicable experiences that you're able to bring forward. But is it at a premium right now, knowing the type of land that needs to be secured, knowing the type of resources and the staffing as well right now?
Yeah, so we continue to see significant opportunity for new venues. You mentioned very well, Brad, our venues are highly repeatable. So the types of sites that we look at and what we build, we're able to build on the same footprint and provide the same fantastic experience. I think in this environment, what we're actioning and for the summer is bringing value to our players' lives. Value is always important, but at this moment in time, we've launched Sunday Fun Day, which is for families, which meets families where they're at. We have Topgolf Nights or TG Nights, so that nightcap or after dinner on a Friday and Saturday night where groups can get together and have a fantastic time at Topgolf. And then next week, we'll be launching an advertising campaign where Monday through Thursday, half off golf at Topgolf. I mean, what's better than that? So filling the venues up is our priority. So we see a lot of growth in that. The testing of these value initiatives have gone extremely well with driving traffic. So we're excited to meet players where they're at this summer.
That kind of gets into our next thought here, which is what you're seeing in the pulse of the consumer right now. Those who kind of look at this as both an experience economy play, but also a food away from home, or on the corporate side as well. I know you run events. So all those things kind of married together here. What are you seeing in that pulse of the many different types of consumers that Topgolf engages with?
Well, players are looking for great value. And the question I posed to our team and our marketing agency, a short while ago is like, why would you just eat? Why would you just do something when you could do it all at Topgolf? So we view an experience at Topgolf as where you can have an active live entertainment experience where you're a part of the action. We have unbelievable food and beverage. We hear it from time and time again from our players that they are pleasantly surprised at how great the food is. And what makes it all tick is our playmakers. We call our team members playmakers because they make play. And when you gobble that all together, we're seeing our value scores improve. We win on fun and atmosphere and overall experience. And we're extremely optimistic that whether it's an experience economy or an out-of-home eating economy, we're there for you.
It's interesting in the context of some of the economic data and the latest consumer price index report. We did see a little bit of a slowing in price increases for goods, but more of a softening in price increases for services, indicating that demand is falling off for consumer spending on services. So Artie, how are you anticipating being able to stomach any slowdown in services spending from consumers, especially as we haven't even seen the full economic impact of those tariff policies?
Yeah, great question, Madison. Well, the first thing I would say is our teams have done an extraordinary job being more efficient and expanding our margins over the last 5 years. It's been well documented. Our margins from 2019 to today are up 400 to 500 basis points. And we continue to have optimization inside of our business model, where use of technology, simplifying various things inside the venue, that we still have room to improve the efficiencies inside the box or the 3 nets of a Topgolf, if you want to call it that. Right now, we're focused on meeting the players where they're at, and we have room in our value architecture. We've been very low promotional historically, and the things that we've launched of late are driving traffic. We talked about this on earnings, where the Sunday Fun Day, the early week value, and the TG nights are working and they're resonating. And the Topgolf business model is really about filling the box up. And Brad, you mentioned that you were in various Topgolfs across 6 states. I love your golf swing, by the way. I think that place, a Topgolf venue, is when it's full, people have more fun, people are going to spend more, and they feel like it's a more valuable experience. So traffic's the focus for us right now.
Artie, we only got about 30 seconds left here. This has always been a technology play that's really kind of enamored so many different visitors and new golfers that you've been able to bring in and grow the game with. When you think about investments to essentially expand Topgolf from here, what do those investments look like?
Well, games is probably top of the list. So we've had an extremely successful partnership with a couple big movie titles, media titles, Sonic the Hedgehog, and most recently Captain America. We have another one coming forward where we leverage our Top Tracer technology. We have it in all venues now, but in early July we'll have the Fantastic Four experience. In the fall, I'd love to come back on your show and talk to you about the sports partnership we have coming, but there's a big sport in America in the fall, and we expect to be a big part of that. So our focus right now is leveraging the fabulous technology that we've invested in and built, and utilizing it against big properties, big media properties, big sports properties that our players love.
Artie, really appreciate it. Thank you so much. Artie Starrs, Topgolf CEO, and Brad Smith for bringing us the conversation. Thank you.
Thank you so much.
Coming up, we got Wealth. It's dedicated to all of your personal finance needs. Brad Smith, he's going to have you for the next hour, so keep it here for more.